Josh Abramson, welcome to Built to Sell Radio.
Thank you. Thanks for having me.
I want to start with a dude that has the confidence to turn down a $9 million offer at the age of 18. Like, when I read that, I was just blown away. So walk back that story. What on earth did you do to get a $9 million offer as an 18-year-old?
Yeah, so, it really started off, as a project that I thought, maybe if I was lucky, I'd make a little bit of money, but I didn't anticipate it ever turning into, an actual business that was going to, make millions of dollars or even, tens of thousands of dollars. But then that all changed very quickly. I started College Humor in the fall of 1999. So I was a freshman in college at the University of Richmond. And then, very quickly started making a pretty good amount of money for a college student. So I was, I think the first month that we were online, we got a check for like $2,500. And then the next check was $5,000 and then $10,000 and then $20,000. And it kind of just kept going.
What was the business?
It was really just, I remember when somebody told me many years later, they were like, "Oh, so you have a media business?" And I was like, "Well, I don't know what a media business does actually." And, of course I'd been building a media business, but I'd never, used that term before. I didn't really understand the media business, but, the idea was broadly just, let's put content on the internet and then we'll sell advertising against it. And it was also at a time when, I think I explain this story sometimes to entrepreneurs who, miss parts of it because it's just a very different market right now. Back then in 99, it was the case that you could just, put just a line of code on your website and you would start getting checks every month. I mean, they would just, put banner ads on the top of your page and you would make a couple of dollars CPM. So, we were highly incentivized just to generate page views. There was no, thought around, as media businesses today have gotten much more advanced with targeting and segmentation and those types of things. Back then, it was just like, how many people can we get to the website and how many page views can we generate because it's just going to make us more money.
And
so
they were coming for jokes, right? Humor.
Yes. So in the beginning, if you were a college student in 1999, it's likely that you didn't have high-speed internet when you were graduating from college or from high school rather. And then when you got to college, you had probably a brand new laptop that your parents bought you, and you had high-speed internet for probably the first time in your life. So there wasn't, this is many years before YouTube or Facebook. There wasn't a whole lot to do from a content perspective, certainly relative to, today's world. And what we would used to do is we would literally just like email funny pictures and videos to each other, and people on our hall growing up, in college would have like, a server on their desktop basically that would house, all the different, funny videos that they had collected basically. So College Humor really was just like, well, let's just take all this stuff that's kind of floating around the dorm rooms, like quite literally just getting passed around over Instant Messenger and email, and let's put it all in one place, and, try to promote it and get people to go to that website. So that was really, it was a very simple idea. And then it started to get a lot of attention very quickly. I think, in part just because of the moment in time that we had started it. And there were a couple businesses that were trying to aggregate content websites like ours. One of them was called eFront, which was a venture-backed company that was out acquiring businesses. And their model was basically, we're going to make you an offer, which in our case was $9 million. We're going to pay you out, a small percentage of that today. And then the rest is just going to be a function of, your, continued audience growth and page views over the next couple of years. So it's basically an earnout. And at first it was, I was 18 when I got that offer. So I was just like, wow, this is insane. But then I showed it to my father who, had run businesses before, and he brought in his attorney. And, once I started talking to people who were more sophisticated than myself about it, it started to, we started to poke holes in like, what is this company like? What are the chances that they actually can pay all this money? And then I think the conclusion that I came to on my own was, look, based on what we're making right now in ad revenue, if we just continue doing what we're doing, we'll eventually make this much revenue anyway. And we don't really have much in terms of expenses. So I think that we'll own 100% of the business and we'll make this money regardless if the internet advertising market continues like it is currently. And there are already some small cracks in the seams of that market that we were starting to just notice. So there was a little bit of a question mark of like, is this, at this point we're in like early 2000s. So there's a little bit of like, well, maybe this isn't going to go exactly as these guys think. So while we did walk away, it wasn't like somebody, put a $9 million check in my hand and I ripped it up.
What was the downstroke? Like, what was the cash portion of the $9 million?
I recall it being a couple $100,000. So maybe $300,000 or $400,000. And then, something like, whatever, $100,000 a month or, some amount for 3 years, which was, again, had we done the deal, that company ended up going bankrupt, I think, less than 2 years later. So
the acquiring company.
Yeah, maybe it was 18 months. So we certainly never would have gotten that money.
Interesting. And as you look back now, I know that was a long time ago, but what's the key lesson that you take away from that experience?
Well, I think, the one thing that I think about a lot with all businesses and, certainly speaking to a lot of friends who are in the, venture capital business, I think a common issue that first-time entrepreneurs face is this sort of like just the lack of ability to really process what compounding growth looks like over an extended period of time. And, I always think of that old story about the guy on the chessboard and he wants, a grain of rice on the first, square and then 2 on the second. And then by the time you get midway around the board, there's never been that much rice in the entirety of the world to like fulfill that. So like that idea of like just not really being able to wrap your head around what that looks like over time. And I think about, people who just, they sell early because they're not really thinking about, well, like, we're growing 20% a year, but like, what does 20% a year of growth look like, 5 years out or that sort of thing. So I think it was, partially just feeling like we, had something that was growing and, this was it was like a specific situation where there was a big earnout and in order for the earnout to be valuable, the business had to maintain value anyway. And we just did the math that, if the business continued to become more valuable or as valuable over that period of time, it would be more lucrative to just own it outright. Again, I think if they had just offered me $9 million cash, like I would have taken it and we probably wouldn't be having this conversation right now.
Yeah, for sure. Well, walk us through what happens next, because you team up with some friends and sort of continue to build this business. What was the next sort of major milestone for this business?
Yeah, so we what was interesting is, as the entire ad market sort of fell apart, that was actually for me, I think the moment, the biggest inflection point in the business, because up until then it was like so easy. It was too easy. It was like we were just putting, jokes and funny pictures and funny videos that we weren't even making mostly on a website. And we were just getting checks every month. And it was just, it felt like magic. And then that went away. And at that point we'd saved up a little bit of money, and it was just my best friend from high school and I who were working on the business. At that point, we brought on a third partner who was an engineer who was, hugely important to the business. But it was just the three of us, and we were all college kids. So we didn't really need to make money or certainly didn't need to make a lot of money. And that was when I really started to figure out how to actually make money on an audience on the internet, meaning like, it's one thing to just put ad code up and get a check. But when you're actually having to figure out how do I get people to transact or to actually facilitate commerce, and, started to do affiliate programs and, actually go out and sell ads myself in a way that, was not easy, but you start to learn that, with kind of like I don't want to just say local advertising, but advertising for small businesses, you can sort of grind your way into some revenue there because, you pick up the phone 1,000 times and you're going to get some people, assuming you have something of value to sell, you're going to get a couple people who bite. And if you can target the right people and they can make a little bit of money advertising with you, then they'll come back. And so I learned all of that in a real way, just by like feeling like I had to figure it out and having my back against the wall because, I had a little taste of what success feels like and how good it is to just, be earning more money on a monthly basis than you know what to do with. Like that was a pretty intoxicating feeling because I'd never had that before, of course. So that desire to just, get that back and to not lose this thing that we were building, I think was really, a huge turning point for us. So that was, 2001. I was a junior in college. By the time I graduated, we were making enough money that my business partners and I decided to just work on our business full time. I always felt like
This is still College Humor?
Still College Humor. I always felt, though, that College Humor was a means to an end. Like I used to say, I couldn't imagine being like, 30 years old and running a website called College Humor, which, I'm trying to think how old I was when I finally left College Humor, but probably about that old, maybe a little older. But it was more about just like feeling that the internet back then really felt like the Wild West. It was like we just were, overflowing with ideas for businesses we thought we could start versus today where I feel like everything is super crowded and it's really challenging. Back then, and maybe part of this was just me being young, but it really felt like there was just endless opportunities and places where we could do stuff. So, and I felt really confident about our relationship as business partners, and we all sort of had different talents and worked together well.
How'd you guys deal with the equity split? Because you were coming at this with some assets, right? You had a website. You brought in the engineer. Did you guys just go a third, or did you?
We ended up
have to earn it, or what? How did you guys structure that?
It changed over time, but by the time we sold the business, it was 35, 35, 15, 15 between my two, because we then brought on a fourth founder. And, it was a little bit unorthodox the way that we did it. I think for a while it was, we were thinking about it in terms of like actually splitting our revenue. So, when there was 4 people, everybody was making 25% of our total income. And that was just like how we were paying each other. And that became a real number. We were making millions of dollars a year by the time we were, 24. And so that was like, and we were living in an apartment that was a business expense because it was also our office. So we had like no expenses, just like taking, big chunks of cash out of the business. So that felt really good, especially because we were so young. But our equity was split a little bit differently. And I think, it was, these things are sometimes as much art as they are science in the early stages, especially when, you're talking about people that you're living with and working with every day. And, I think it worked out fine in the end, but it was definitely, there were moments when it became, tricky just because, our agreement was essentially that, all new businesses would be split equally. And the College Humor business was split in a different way. And then we started Busted Tees, which quickly became more lucrative than College Humor, even though I think we all agreed that it wasn't as valuable as an asset. So ultimately, we just decided we're just going to split everything 35, 35, 15, 15. And that was how we did it.
What was Busted Tees? Tell me about that company.
So in 2003, we were living in California. We moved to San Diego, which is, kind of a funny choice for like a, internet startup at the time, but we thought it would be really fun. And we thought we could do it from anywhere. So we moved to San Diego and we were working 100-hour weeks easily. We were just, living and breathing our business in a way that only a person that young, I think, can do. So, we were trying to figure out like other stuff we could build. We had built, before Facebook, we kind of built like a social network, but it was for college kids, but we thought it was really more for people to date. We didn't realize we didn't have the like same vision. And obviously it, didn't really work out too well, but a lot of time and energy went into that. We'd started some other little things on the side and none of them really got traction. But at the time, our biggest advertising vertical was t-shirts. There were a couple t-shirt companies. And I remember one guy who had a t-shirt business had just bought Robert Downey Jr.'s loft in LA. And like, we found out about him. We're like, well, that's crazy, selling t-shirts on the internet. And this guy was, paying us quite a bit of money every month for advertising. So, it wasn't a super out there idea. It was like, well, if this guy's making money doing this, like, I think we can do it as well, or maybe better. And we have, my business partner, Ricky, is very funny and has great ideas. And he was sort of the editorial lead for the comedy business. So we're like, well, what if Ricky can just come up with t-shirts and we can, make our own? So that was really how Busted Tee started. And then over time, we, got more sophisticated and had, more writers contributing, and it became a real business. But that was really how we started. Was we were struggling to find, an advertiser market fit for College Humor. So we were doing very transactional type advertisements. So people who were, really like buying ads to make money on the back end, as opposed to brand advertisers. And then the irony is that when we started Busted Tees, that was when I finally started to kind of crack the code on how brand advertising works. And I remember we got a deal from Toyota and from some other like major brands. And those deals are much more lucrative than anything that's based on, ROI, at least for us, for a comedy website that wasn't super targeted. So we built Busted Tees, started growing like a weed. And then all of a sudden, we similarly kind of hit the hockey stick, so to speak, on our growth in College Humor, because we figured out how to sell ads. And then we moved to New York, and that's when I started to build out a real sales team and hired people who actually, had worked at bigger companies and knew how to sell to agencies and that sort of thing. And then, when we moved to New York, it was like, that first year in the city was crazy. We met so many people. That was how we ultimately got connected to Barry Diller, and around that time also started Vimeo. And
where you can't just throw that into like a side comment. Oh yeah, we sort of started this thing called Vimeo.
That's kind of how it felt, to be honest. I know Vimeo is, of all the businesses I've started, the one that's certainly the most valuable today. But it was also the one that was kind of the most side project, like at the time.
Really?
My business partner, Jake, again, like our mentality was we even called our company Connected Ventures. We wanted to just like keep starting businesses, College Humor being one of them. We had started Busted Tees. We'd started another t-shirt company that was more sort of like high-end fashion that didn't really work. We were still running the college social networking business, but at that point, Facebook had started, and it was kind of clear that we were not going to be Facebook by any stretch. And my business partner, Jake, was one of the early vloggers. He was like, there weren't that many people who were sort of documenting their lives on the internet and posting those videos every week. And he was doing it and had, from the College Humor experience, there was, I think he was just very well equipped to understand where video was heading. And the idea for Vimeo for him was really, he was making these videos every week, and it was, you basically had to be a web developer to upload a video to the internet at that point in time. I certainly didn't know how to do it in 2003. So it was really just building a website that you could upload your videos to share with your friends and family. The vision was more like Flickr for video than it was what YouTube ended up becoming. We actually, and I think part of the reason we didn't build YouTube is my fault, because I was so anti anything copyrighted ending up on Vimeo, because we'd been sued at College Humor. I knew we were probably going to sell College Humor by that point because it was making a lot of money. And I just, that was what I felt. And Vimeo, if we got in a lawsuit with Viacom, who were also, trying to sell our business to, like that was going to be a problem. So we really put restrictions on the website to make it so that anything that could potentially be, a clip from the Daily Show or whatever, would get flagged and taken down. YouTube did the exact opposite. I mean, they basically leaned into copyrighted material, and I think it's been well documented that was, part of their strategy. So, yeah, we just took a different approach, and it was always a side project. I mean, it was like, excuse me, my partner Jake would sort of have to like beg me for time to spend on it, because we had other things that were, it's sort of the innovator's dilemma, right? You're like, working on one thing that has value. You have another thing that is basically a seed stage startup. Does it make sense to put your top engineering resources into this new thing when you're you can sort of see the finish line on the other thing? So that was part of the issue. We eventually sold the combined businesses in 2006 to 𝙁𝙊𝙐𝙇𝙊𝙀. And it wasn't until that happened that we really started to invest more heavily in Vimeo.
So when you say you sold the combined businesses, you're referring to College Humor and Busted Tee.
And Vimeo.
And Vimeo.
Yeah.
Okay.
So those three businesses were all combined in, we called Connected Ventures. Vimeo was, the truth is, like, I made $0 on Vimeo, like, ever. Like, it was, it was such an early stage business that it kind of just got grouped into the College Humor business. And I tried to split it out and, maybe raise money for it separately or see if there was interest for Vimeo on its own. There was not. We talked to some of the top VCs in New York, and everybody thought it was interesting, but nobody was like, let's do this. And I think from 𝙁𝙊𝙐𝙗's perspective, our deal was structured so they were buying 51% of the business, and then we had a put option to sell the remaining 49% 5 years down the road.
Can you explain what a put option is?
So basically, we had the right to force them to buy our remaining shares at not a predetermined multiple, but basically there's a mechanism that they called baseball arbitration, which is effectively a way to negotiate a fair market price. So we come up with the price, they come up with the price. We sort of have a negotiation period, and then if we can't agree on a price, then we each submit a bid to an arbitrator, and they will pick a number. So you're incentivized to not be too unreasonable. So that, that was how that all came together. We had this put option, and that sort of gave us comfort that, well, if we create a lot of value, then we'll be able to, capitalize on it in, the longer term.
Got it. So you sold 51% to 𝙁𝙊𝙐𝙗. For people who don't know that name, that's Barry Diller's company. He's been famous for buying up internet companies and taking advantage of economies of scale. He's been prolific at that, as I understand it. So you took 51%. So you became a minority shareholder, but you had this put option, which enabled you to sell the remaining 49% at effectively a fair price that you felt you were protected. So what happened? What was that period like after 2006 and you sold to 𝙁𝙊𝙐𝙗?
It started off great, and then it quickly became not great. Part of the issue was we sold a niche content business to a very large multi-billion-dollar public company who had very large ambitions for what we were going to build.
How much revenue did you guys have at the time?
I think it was about $6 or $7 million the year that we sold, but we were operating at about a 50% EBITDA margin.
Okay, so it
was profitable.
And this is College Humor plus Busted Tees plus Vimeo.
Vimeo was just an expense at that point. We were not making money on Vimeo at that point.
Got it. Okay. Got it. So back to 𝙁𝙊𝙐𝙗. So you're a $6 million business, but really fat profit margins. You go to work for 𝙁𝙊𝙐𝙗, and what happens next?
So what happens next is we start missing our projections pretty quickly. We had, obviously you're out selling your business. You sort of expect that you're going to continue to grow on a certain trajectory. And then all of a sudden, Facebook and YouTube start to eat everybody's lunch. And we couldn't quite see the writing on the wall right, at that moment, but it became clear over the next few years that, well, YouTube is a huge force. Obviously, looking at it today, like the idea of starting a business like collegehumor.com is just like, impossible to even imagine. So we had sold a bad business model effectively. That was, it made sense in the early 2000s. It was starting to make less sense. That was also combined with the fact that, I was 25 years old and now I was reporting to Barry Diller, who's, this iconic businessman and not known for being, having a soft touch with managing people. So, it was, and I'm also a very different type of person. I don't think I could ever work in that type of environment again. Like, I don't respond well to people yelling at me. I don't, it's just not, it's not who I am. So all of a sudden I'm in this conference room that's, massive with like $1 million carpeting, which is actually true. And you're sort of sitting there getting yelled at by these like very adult grown men who are like A, smarter than me, B, like orders of magnitude more experienced than me, and C, now they like own my business. So it wasn't a super fun experience. I learned a ton from them. I'm glad that I did it, but I can't say that I enjoyed it.
How did it end? Did you exercise the put option?
We did, although, that those put options are tricky, right? Because first off, the bigger company ends up having a lot of leverage in these negotiations for a variety of reasons. But, you don't really want to go to arbitration because that can be expensive. And when you're talking about a business that's, maybe if it's a business worth billions of dollars, it would go differently. But our business was not worth that. So, there's incentive to not go to arbitration. You also have to imagine that the arbitrator is likely to side with IAC or any big company over like some smaller entrepreneurs. I just think it's hard to expect that there's not going to be some conflict there. And we never went to arbitration. So I am just sort of, recalling the advice that I was given by our attorneys and people that, had been through it. And I think it's also very unusual that you end up going to arbitration. I think someone who used to work at IAC told me it was like 1 in 10 actually go to arbitration. So when we finally did exercise our put, it was fine. And I was happy with our price. I think it was actually a good price. But we had to extend our put. So it was originally a 5-year put. And then when we found a production company that we wanted to buy, which we did buy. But in doing that, we were sort of told, well, you need to take, another $15 million on your balance sheet, and we're going to dilute you at what we think the business is worth now, which is not as much as we paid you for it. So we got, our equity was reduced, which was frustrating. It all worked out in the end, but it wasn't a awesome moment. Just
Josh, you just went way over my pay grade. So you kind of threw in a couple things there that just went right over my head. I felt like I was back in university. So explain that to me one more time. So you've got, you sold 51%. You've got a put option on 49%, meaning you are theoretically entitled to sell your shares at a predetermined loose formula to IAC. You say, okay, I want to sell these shares. They say, okay, we'll buy them. Is that what happened?
So yes, but before that happened, we had to punt on the date it went from being 5 years out to now 8 years out. And we basically said, all right, we want to buy this other company. They said, okay, in order to do that, you're going to have to extend your put and you're going to have to take a lot of dilution. Or you could just not do this deal, which everybody, including us, thinks is a good deal. And we think everybody's going to make money. But that was sort of like, a little bit, the reality with a company like IAC, to their credit for their shareholders is when they have leverage, they use it. And we were at a point where we didn't have a lot of leverage. We were running a business that was growing at a decreasing rate. We were kind of grasping for their opportunities to have a bigger outcome in the end. So, we got squeezed a bit. When we finally did exercise our put, we did get some value from the company that we had acquired. And we did get a very fair value for the College Humor business. The Vimeo business had been spun out by that point, so we didn't receive any value for that. Vimeo was sort of left for dead a couple times over the years. The Vimeo that exists today, it looks a lot like the Vimeo that we made back in 2005. But we haven't been involved in it since, it's been 15 years. So it's a very different business, and I can take some credit for it existing. I can't take much, and I certainly can't take any credit for how successful it is today.
Got it. So you got some value in that put option play. You had some value for College Humor. And how did they value it, on a multiple of revenue or EBITDA, or what was the valuation mechanism there?
It was tough because the business became unprofitable pretty quickly, intentionally, because, the whole idea, and this was something I didn't understand when I sold the business. IAC has a lot of companies, and for something to be meaningful to IAC, it has to be a big business. We were not a big business, and College Humor never became a big business. But, from my perspective, I owned 49% of a company that was generating millions of dollars a year. It had a tremendous amount of value to me personally. To IAC, it was just a blip. So from their perspective, not unlike a venture capitalist who's like, let's pump as much money into a business as we can, and hopefully it's $1 billion outcome. If it's not, then it goes to zero, and that's okay, because we, bet on 20 other companies in this fund. I think IAC was taking a similar approach to us, which was to say, like, this is only interesting if it becomes big, so we want you to take a big swing. And that was always a little challenging for me, because I didn't really, I grew up in this business, counting pennies, right? Like I wasn't used to just like spending money without knowing that it was going to generate a return in the short term. So the idea of spending millions of dollars in hopes that something would become valuable in the future was difficult for me. So I think a lot of the friction between myself and Barry and IAC management really stemmed from that simple just disconnect, where I was trying to preserve value in something that I owned a tremendous piece of, it was half of my personal net worth was in this business. They were trying to invest in something and grow it so that maybe it meant something to them, because at the time it meant basically nothing to them. So that was part of the issue. When it came time to exercise the put, the business was not profitable. So it was hard to value. I think in the end, it was, there were some other people who were interested in buying the business. And I think, a small process was run to see if it made sense to sell it. Obviously they didn't sell it. So, but I think that the numbers that came back in that process were also used as sort of a comp for what we thought it was worth. So it actually turned out to be quite fair in the end. I wasn't so sure that it would end up that way, but fortunately it did.
Do you recall how they arrived at a valuation? Like, was it a multiple of revenue if it wasn't profitable?
I think it had to be a revenue multiple. It's been a couple years, so I don't remember exactly, but there was we also had a production company that was the one that we bought that required us to take some dilution, and that was basically like almost like a terminal value, because we had these assets that were generating revenue, TV shows and that sort of thing. So you could kind of do the math for like what those might be worth. So that was part of it. And then the College Humor business was just a function of the revenue, and that it couldn't have been profit because we weren't making any money. And by that point, I'd already bought the Busted Tees business out, so that wasn't a factor.
Yeah, I want to go there next. So the Busted Tees business, if I'm getting this right, you had College Humor. Ricky's kind of a genius at coming up with cool creative things. You built a t-shirt company because you're like, well, this guy's making all this money. So you had Busted Tees as a t-shirt company and College Humor. Vimeo was a bit of a side project. You saw the future of video. You sell it all collectively to 𝙁𝙊𝙐𝙇𝙇. Walk me through how you then scraped out Busted Tees from that equation and kind of took that. And
I always loved the t-shirt business. It was so simple and sort of elegant as a business model. Like, you're coming up with ideas, you're putting it on a blank t-shirt and you're selling it. And sometimes we would sell a lot of them, and it was just fun. After we sold to 𝙁𝙊𝙐𝙇, the Busted Tees business was making, call it like $1 million, $1.5 million a year in profit. So it was, again, by my 25-year-old standards, owning 35% of it, that's great. By 𝙁𝙊𝙐𝙇 standards, it's like, why are we even talking about this? It was just like a distraction in their view. So at a certain point, Barry Diller told me, I don't want you spending 1 second of your time on this business. And basically was like, if it ever makes less than $250,000 a quarter, I'm shutting it down. So like, you can't work on it, nor, so it was just like, okay, well, that's frustrating because I still owned a big piece of it. So if he shut it down, it would just be, imagine owning a big chunk of a business that's making over $1 million a year, and it just gets shut down without you having a say. So that was sort of where we were. I had a 5-year employment agreement that was coming near an end. And I think everybody knew I wasn't necessarily the person who Barry was going to want to continue running the business. I didn't want to be that person. I'm an entrepreneur, not, an operator of a, division of a public company. That's just like not that's not who I am as an operator. So we all kind of collectively decided we're going to hire a new CEO. I'm going to put my pencil down, and that was it. So in the process of doing that, I had some equity that was given to me at the time of the acquisition, which had not vested yet. Yeah, exactly. So I can't remember. I think it was my idea, but to be honest, I can't even recall. I think maybe it was because they wanted to shut it down, or, it's been, 13 years. But what I do remember is, sitting down with the CFO and saying like, look, well, I have, this employment. And by the way, they had upped my employment agreement. So they had to pay me for the next 4 years. Whether I worked there, I could have just not come into the office. And that was part of, another deal. There were a lot of little deals that we did over the years that changed all of these sort of dynamics. But at this point, I'm sort of sitting there. We'd hired this new CEO. Everybody knew that, I was not going to be the CEO anymore. And I didn't really have a whole lot to do, honestly. I didn't want to sit and just collect a paycheck for 4 more years. So I basically said, what if you just give me the Busted Tees business, and you don't have to give me the 𝙁𝙊𝙐𝙇 equity, and you don't have to pay me for the next 4 years. And they said, well, that would be kind of a rich deal. Like, what if you give us, I think it came to $400,000, which is the difference between what they thought the business was worth and what all of my equity and everything else was worth. And, based on the value of the inventory and so on. So I was like, okay, sure. So then I did that. May 1st, 2011 is when I left. And the day I left, I brought 6 people with me who were the Busted Tees team, moved into a kind of dingy loft with a small mouse problem. And versus my 𝙁𝙊𝙐𝙇 office was floor to ceiling glass windows in the Frank Gehry building where I had a little private mini refrigerator with the drinks I liked in it. So it was a big change, but I loved it. It actually felt, even to this day, I would prefer that. It just feels more comfortable to me. And just the culture that is built in that type of environment is more, pleasant to me. So anyway, so we go, and then
before we go too far into Busted Tees, I just want to ask, what could you put an estimate to the value of your 𝙁𝙊𝙐𝙇 options plus the 4 years of salary? Could you ballpark what that was worth?
It was $2.5 million.
Okay, so plus the 400 grand you put in, so you bought Busted Tees. You
Basically,
could maybe make an argument for around $3 million.
That's right. Yeah.
And then it was making more than $1 million in profit every year.
By that point, it was down a little bit. It had sort of, I think that was part of the reason why they were also willing to sell it, is it did fall below that number that Barry said, I'm going to shut it down. So I think the year that I bought it back, it made $600,000 or $700,000 in profit.
Okay.
And then it just kind of, and it had been on a sort of downward trajectory for the past 3 years. And then I bought it back and then just felt confident that I could do better if I was focused on it. And sure enough, the following year made $1 million, and then it made a little more, and it kind of just reversed course. And also, put me in a position where I felt like I had early in the College Humor days, which was, this little t-shirt business, I don't think is like the thing that I'm going to, go down in history for, like the thing that's going to be my,
Cement your legacy.
Yeah, I don't think so. So I sort of felt like it would be a good starting point to build something else. So I was very, kind of feeling frustrated at times and sort of, wishing that I could come up with something bigger, and had a couple false starts. And ultimately that's what led me to build TeePublic, was sort of that desire to do something that just felt more scalable.
Okay. So walk me through what was the pivot between Busted Tee, which was your own creative on t-shirts that people bought, as I understand it, to what ultimately became TeePublic.
So the reason that I first had the idea for TeePublic was, when you're coming up with your own ideas for a t-shirt, right? Like you have a certain cost that is associated with actually producing it, right? So you have to make 144 units as a minimum. You have to burn screens. You have to, take inventory. You have to pay somebody to design it. You have to pay somebody to come up with the idea, all these things. So, there's a real cost. And we realized pretty quickly that the more shirts that we would release, the more revenue we would do. At the same time, you release 20 t-shirts in a week. One of them might sell 7 and the other one might sell 700. So you just don't know what's going to do well. Even after doing it for many, many years, it was still always a crapshoot. So, we started to think about, well, what if we just figured out a way to, put a threshold on sales in order for a shirt to go to print. So basically, like, we're just going to put all the designs out and let people decide what they want to purchase. And if enough people decide they want to purchase it, then we'll make it. So that was the original idea. And then it shifted in that first year because, the biggest reason is digital printing really took off. And, the early examples of digital printing that I saw, in the early 2000s were like kind of just like very low quality iron-on patches like you would get on like your Little League t-shirt like way back in the day. What happened though is digital printing became very high quality and the cost started to come down. So we sort of shifted the model and then said, well, how about instead we just make it, an open marketplace, and any designer can upload any designs that they want to sell on a t-shirt. And then we'll just handle everything from the production, fulfillment, et cetera. And that was when the business started to really grow. The first year before we made that shift, it was pretty flat. And then we made that shift and then it started growing 50% month over month. So I think, the first year the business did maybe $200,000 in revenue. And then I think the second year, maybe we did $4 million in revenue or 5. So it grew very quickly after that first year.
Wow. And again, so I understand the pivot, instead of designing it, speccing it, buying 144, you let people upload their own designs. And then basically almost like a Kickstarter, the user community would select the shirts that they want to produce by pre-ordering them effectively.
Kickstarter for t-shirts was the original concept. Yes. Then it shifted more to, an open marketplace again, where anybody could upload anything. And by the time I sold TeePublic in 2018, we had over 3 billion active SKUs that one could theoretically purchase on the website. The fact that we didn't have inventory is what made that possible. So most of those designs never would get purchased, but it was basically just allowing for anybody to upload anything, which starts to create a massive curation problem. But on the customer acquisition side, you are pulling in customers from so many different search terms that it really became an organic search business. And that was the inflection point and how it really grew into a bigger business.
When it became an organic search, like people were searching for funny t-shirts and you guys would pop.
Yeah, because my first thinking was that the designers would be the marketing, in the same way that like in Kickstarter, you start a Kickstarter campaign, the people behind the campaign will make a video and, they do the marketing. And if it's successful,
Sure.
Obviously the Kickstarter platform gives them a boost, but, you sort of have to do it yourself to a certain degree. The issue with that when it comes to t-shirts is most t-shirt designers are not good at marketing. So that just didn't work. People weren't able to generate enough sales from their social traffic. A couple people were, but the majority of people were not. So we really had to build an engine that generated the demand ourselves. And fortunately, we were able to do that. And it again, like when I had the idea for this business, I was not like, we're going to build an organic search, monster that just has all these different SKUs. It was not planned out that way. But I think, pretty quickly we started to feel our way into that. And that was ultimately what made the biggest difference. I mean, if you have an e-commerce business and you are out there acquiring every customer with, Facebook ads, paid search, whatever, it's really hard for that to work. There's a couple verticals, a couple businesses that have done a great job with it. But broadly speaking, it is hard unless you have some secret sauce around customer acquisition, something that has a little bit of virality into it, some sort of network effect, something that just utilizes the power of the internet in a real way, versus having to acquire every customer again and again and again. I think that was the magic of TeePublic, is we created that sort of framework that just worked from a customer acquisition perspective, and that's why it worked.
You were able to get organic traffic, so people typing into Google words that would send them to your site.
Exactly. And that's the benefit of having an open marketplace like that, because something pop culture events would happen, and we would have during the Trump Clinton election, it's like we had people designing shirts pro and against both sides. It was like that was the case with any political issue or any piece of content or something. You could sometimes I would just get bored and I'd be like, I wonder if we have a t-shirt about this like just random thing that like one of my kids said or something. And like, sure enough, there's like pages of it. So you also end up with these like, very passionate sub communities of people who are passionate about, something obscure, something, whether it's like an old comic book or like, a TV show that like maybe I'd never heard of. And then there's fan art that gets created around that area, which that wouldn't really work on a Busted Tees model, because you're trying to appeal to a larger group of people. This really leaned into a long tail model where you've got like bronies, kind of grown men who are really into My Little Pony. Like they buy a lot of brony t-shirts. Like who knew? So there were a lot of things like that.
Is there really such a thing as gronies?
Bronies, yeah.
Look
up bronies. Okay. You'll see like very manly looking men wearing like unicorn,
That's awesome.
So it's, you would discover all these kind of funny little pockets of the internet that were buying, t-shirts that they sort of, associated them with whatever that thing was.
Did you ever, I think any sort of two-sided market runs the risk of somehow, being seen as endorsing a certain seller. Did you ever have to like police what you were putting up on the site to make sure? Yeah. Okay.
It was hectic. We would, if I were back in, I don't know I haven't been involved in the business for a couple of years now. But at the time, during the amount of time that we've spent speaking to each other today, my phone would have had dozens and dozens of cease and desists. So it was, and some of them, we tried to always take the policy of, there's the DMCA, which we follow as closely as possible, that gives us the right to act as sort of a, neutral platform.
What does the DMCA stand for?
It's the Digital Millennium Copyright Act. It basically says that, if you comply with a certain protocol around, takedown notifications, and, for example, if, somehow on TeePublic, there's a picture of your logo for your brand and it ended up on TeePublic. We take it down immediately. There's sort of a process with which the artist gets notified, and, all this sort of legal stuff that is very fine tuned to be as, to limit liability as much as possible. And 99.9% of the time, that was fine. And, we would take it down and people were satisfied. But then you get the occasional bad actor or somebody who just wants to, have a lawsuit for sake of having a lawsuit. And those were actually the ones that were the most annoying because, they're just like ambulance chaser attorney types who just are chasing down, dollars. And that was, I did not enjoy being on the receiving end of that. But that was just one of the, costs of doing business. I think, we really tried our best to act well and to not be jerks, and to, we didn't want to steal people's IP. And when we found out that somebody was, we, acted as best we could, but that still meant that there was a lot of just legal back and forth and things that we had to deal with.
Who's the we when you put up your own unvested stock options and your own 4 years worth of salary, and you put up $400,000 of your own cash? I'm assuming you owned 100% of Busted Tees when you scraped it out, or did you have partners?
I did. And then I hired a GM who was a young guy named Adam Schwartz, who turned out to be exceptionally talented, and ended up giving him a small piece of the business over the coming years.
How big did you get it before you decided to sell it?
When we sold TeePublic, the business made in 2018, I think it was about $4.5 million in profit on $41 million in revenue, I think.
I hope Barry Diller doesn't hear this.
Oh, he knows. I don't keep in touch with him, but I do see him from time to time, and he invited a bunch of IAC alumni to a dinner or a lunch at CES. I think it was CES. So we were there, and everybody sort of, John Foley, who started Peloton, was there. There were a lot of people who had gone on to start, very valuable companies. And Barry asked me to sort of tell the story. So, he does not hold any negative feeling. I think he was very kind and supportive about it, actually.
Oh, that's great. Well, that's very generous of him. So you're $41 million in revenue, $4.5 million in profit. Was there a trigger that made you want to sell?
Yeah, the reality is I didn't think that TeePublic was a business that was going to be acquired. I thought, the legal issues that I just described, they were sort of an existential threat in my view. I was not sure that, a private equity firm. I actually spoke to a couple of private equity firms. They were, once they understood that risk, became less interested in the business. And then realized that there were actually a couple t-shirt businesses, or, Redbubble being one of them, that understood the space and were interested in acquiring the business. I also sort of felt like, I enjoyed running TeePublic. The truth is I miss it. Like I wish I still owned it. I don't regret doing the deal, but I would have liked to have done the deal and continued to own a business like TeePublic. It's hard to build a business that is successful like that. It's not something that you can just go out and do again, the very next day. It's also harder to motivate to do that when you don't need the money in the same way that you did when you were younger, which, at least for me, I think some people have endless amounts of motivation. I'd rather just have dinner with my family, my kids at night, versus like going to like a networking event or doing the stuff that I had the energy for when I was younger. So all that being said, I was happy to continue running TeePublic indefinitely. It's just a cash flow generating business. I was making a lot of money. That felt good. I enjoyed the people I worked with. I enjoyed the business. I didn't enjoy the legal stuff. That stressed me out, but otherwise it was great. And then I just got an offer that was basically, with what I had made previously and adding this to that, I didn't ever have to work again. That was, I sort of did that math, and I, for whatever reason, I think this is the wrong goal to have, but it was a goal of mine, was to sort of make enough money so that I never had to work again, and I could sort of continue living a really nice lifestyle indefinitely and have no pressure. So when I saw that opportunity, I took it, and then very quickly afterwards realized, well, I do want to work, and it kind of feels nice to have achieved this, but it also, like I said, it's not a motivating thing. It actually is the opposite for me. I didn't have the same, identical fire that I had when I was a 24-year-old, like desperately trying to make it. So I think in a way it sort of, it puts you in a situation where you actually are, maybe less willing to take risks because you don't want to disrupt, you have everything you want financially speaking. So why would you risk that so that you can make more work for yourself? Your incentives change and it becomes a different problem to solve. And again, like I enjoyed going to the office. I still enjoy, working and having a business. But it was like I had enough money to buy, the apartment and the beach house and the things that I wanted, but I didn't necessarily have a business that I enjoyed running anymore, so that was a real loss. And I think, the most depressed I've been as an adult, both times, I think, were the periods after selling my two businesses, which is sort of, I've heard people say that before. And I knew going into selling the TeePublic business that I felt that way after selling the College Humor business. But I still sort of, raced towards the finish line. And then, sold the business in November of 2018, left the company 2 months later. And then, January of 2019, I'm in New York City. It's cold. It's snowing. I have nowhere to go. And I'm like, I guess like kind of rich, but that's it. It's like, that actually doesn't feel as good as maybe it sounded to me. And then I, went on this sort of multi-year journey to kind of find my way and find other projects that were exciting to work on. And it wasn't easy. And it's still a challenge to really, piece together opportunities and things without going out and starting something super ambitious from scratch. It can be challenging to find projects that, are more than a board seat meeting once a quarter and less than like, a full-time CEO position, which I don't know that I necessarily have the energy for today. So, it's an interesting, just an interesting, sort of, thing that happens, and it's something that very few people have any sympathy for. So I'm reluctant to talk about it, in too much detail, but it's also just, sort of the reality of how I had felt.
No, you're among friends here. I appreciate you sharing with candor, because I think a lot of our listeners have either experienced that firsthand or will experience it. And so knowing that sense of loss before it happens, I think is a big deal. So I appreciate you sharing. You mentioned that you got an offer that meant with the money you made off College Humor plus this, you kind of wouldn't have to work again. How did the offer come about? I mean, like, multi-million-dollar offers still just going to come out of this out of the air. So did you approach them? Did they approach you? Like, did you hire a banker?
I didn't hire a banker. There was a company called Spreadshirt that was based out of Germany that wanted to buy TeePublic, and
they reached out to you.
They reached out to us, and I was sort of like, if we could get a deal done for 10 times EBITDA, which is basically just 10 times net income, that might be interesting. So that was sort of how it started, and then they sort of continued to poke around, and then finally, gave us a term sheet, and we started to move forward with that.
What were their terms? What did they give you on a multiple of EBITDA?
I think it was 10x, but also our income was growing during this whole period. So what was, $32 million, we ended up selling the business for $41 million. But 32 sort of felt like the right price when we first started talking. And then the business was, growing over all these months. It started to feel like actually maybe that wasn't the right price. But I was still moving forward with them. And there was an earnout component as well. So, if it continued to grow, we would have made more on the back end. Redbubble then, and while this was happening, we reached out to a couple other, like Custom Ink was a big t-shirt company that we talked to, and they weren't really interested, but they, maybe they were, but probably not. And then really sort of on a whim, I reached out to Redbubble and was just sort of like, hey, I think we might be selling our business, but thought you might just be interested. The CEO gets back to us right away. And long story short, has us an offer in like 48 hours, like really fast. He was a new CEO trying to sort of make a mark. So all of a sudden we had, an offer for, considerably more than what we were negotiating. And also, I think it's a decent lesson in overplaying your hand, because, the German company was really kind of turning the screws on us on some deal points that were not, super important. And I think we were in the right to ask for it to be the way that it was. I don't think we were being unreasonable, but, sometimes people in these deals, I think, can just, they need to win on points that, maybe aren't that important. And I think that was starting to happen. So we were getting a little fatigued and frustrated. If they had just moved faster, I think we would have just done the deal and we would have never even had that conversation. I think when you delay a deal, time is the enemy of all deals is sort of the mantra I always have in any of these situations, whether it's buying an apartment or selling a business or, buying something important. Like, the longer you let it sit out there, the more bad things that can cause it to fall apart. And that happened to them. And, then we had this offer from Redbubble, and, in order for us to jump ship, so to speak, and start pursuing their deal, we were very specific about, like, this needs to happen quickly. We need to get all of these terms that we had already negotiated, and like the things that we weren't able to get from the other deal, but we thought that we deserved. And they were basically just like, okay, all of those things. And then we did the deal very quickly.
I understand. I looked at the public disclosures before this call from Redbubble. I think it was 41 million total, 36 cash, and then another. Am I getting it right? I've got to find my notes.
40. Here. It was 41. There was a holdback, which we got all of that money, fortunately. So yeah, it was 36 at closing, and then another 5, I believe, in holdback.
Got it. So ultimately, it ended up being almost bang on 10x profit.
Yep,
10x EBITDA.
Yeah, exactly. Now, it was while we were in the final stages of the deal, we noticed that the business growth was accelerating, and that it was a moment of like, this actually, we could have like a really serious next year or two. And sure enough, that's what happened. And I think, COVID gave a bit of a boost too, but the business grew tremendously over the next couple of years. So you can never time these things perfectly. And I think, we did a really good deal at the time. If I could have predicted a global pandemic that was going to, have a major impact on the value of companies like ours, like I probably could have made a lot of money in a lot of ways. But yeah, it was, I think at the time I remember feeling I'd rather it be that we're exceeding our projections every month as this deal comes together than the alternative. So
Well, you'd lived the opposite, right? I mean, at IAC, you'd lived that experience.
Well, at IAC, correct. But we were, we really didn't start to miss our numbers at IAC until after the deal was closed. Okay. At Redbubble, with that deal, we were, the few months that we were negotiating, we kept beating our numbers materially. And we've realized that there was, not to get too granular, but there was an SEO mistake that we'd made 18 months earlier. That was a big deal. And it took us that whole time to really recover from it. And then we started to realize, oh, wait, this thing that had happened actually, we grew despite it. But had we not made that mistake, we would have grown at a different trajectory. And now that mistake has sort of expired, our original growth trajectory is back on. So while we thought our growth was slowing, it actually was still increasing. So
what was the SEO mistake?
We had a huge takedown request from a large media company, and there were a lot of designs and things that needed to come down like at once, like a huge number. And we were super cooperative. We had like 20 people like scouring the website for like a week, just trying to take down everything that had, any of these, specific IP related pieces of content on it. So like tens of thousands of designs came down. And the way that we did it, I forget the specific way that we did it wrong, but basically we told Google, all these pages, were errors or they weren't redirected in the appropriate way. So we got dinged by Google in a real way, and it took a very long time to fully recover from it. And it also took us a very long time to and it was really like having some extremely talented SEO experts who were looking at it in a more granular way, who were like, oh, this is where the problem was. Like, what happened on this day? What did you guys do then? And then we were like, well, we did this. And he's like, oh, well, that's, there's your problem, So, but sometimes these things, you make a mistake and it can take you a year to even realize that you made a mistake, or longer. And that was a good example of that. Would it have changed the course of the deal or how we thought about it? Maybe, maybe not. But I just thought it was an interesting thing to note.
That your business was about to explode and the temptation was there to retrade on the upside and get a little bit more.
Yeah. I think, also, the reality was, my business partner was very excited about the deal. I had grown extremely reliant on him. He was, a huge part of our success. And I was a little concerned about how long he was going to stick around. And I knew if I had to replace him, that was going to, it was unlikely I was going to find somebody as good as he was. And, so there were some of those types of things out there too, where it's like, all right, this is a good endpoint. He's happy with the deal. I'm, really happy with the deal. This feels like a good decision, for all of the above reasons. But, it's sort of like, you want your ex to like be happy in their life, but you maybe don't want them to be like blissful when they leave you. You know what I mean?
That's a good analogy. Yeah, you want them to be happy, but not too happy.
Yeah, not happier than they were when they were with you.
That's such a good analogy. I love that. What were the deal points? I'd be curious. Again, our listeners are, many of them are about to go through the process of selling their company. And so these granular details that wouldn't be interesting to a lot of people are very interesting to our listeners. I'd just be curious, though, like an example of a deal point that the German company was pushing for that you felt was just an overreach. Do you recall?
Yeah, I mean, It's hard to recall exactly, but there were a lot of issues around, certain uh, reps and warranties around, um, certain things with like regards to, pending litigation or future litigation and how that was going to be handled. And, for example, if, uh, we were to get sued after the deal had closed and there was, intellectual property that had been uploaded to the site while we were still owners, like how that would be handled and who would pay for that and what the split would be, and like those types of issues where, it was a little tricky because you're saying it's like, well, yeah, well, we built this and are delivering it to you as is, but then you're responsible for policing it and for managing any future litigation or those types. So it's a little hard to just give you the keys and then say, well, if you crash the car, like we have to pay for the damage. Like that doesn't really work. So like those types of things. And then, there was some also like, the sales tax issues with businesses like this. For people who work in e-commerce can appreciate how complex it's become. It's actually, I think some of the software now is a bit easier, but, there were just issues around, potential sales tax liabilities and making sure that, we were like totally buttoned up there. And like, I think we were, and, there were just, really just like trying to have all of that type of, the finance and legal side buttoned up in a way that was fair and not, overly punitive to us. So those were like, some of the examples. And then I think, beyond that, I'm having a hard time remembering like some of the specific moments, but I think it's also just like, as you're going through these long form documents and you have, 100 little nitpicky points, and then you get a draft back and like 2 of your changes were accepted. And it's like, okay, well, like you guys, this doesn't feel like we're working towards meeting in the middle here. We're just sort of, you're trying to steamroll us, and, that doesn't feel great. So when a better offer comes along, it's easy to say, okay, well, these guys are just going to give us a fair deal off the bat, and we don't have to like hammer them, every day for 4 months.
Did you have to let your no shop clause expire before you engage with
We didn't have a no shop clause because part of the issue, I guess this is an interesting detail, is they made the decision to have a super robust term sheet. So it was a 10 or 12 page term sheet that was then going to become the long form document, and as opposed to a more simple term sheet and a robust long form document, they wanted to negotiate the term sheet more fully, which turned out to be a bad decision because we never signed that term sheet. So as a result, we were able to just jump ship and we did have to sign the term sheet immediately with Redbubble. So, the other company was, I felt really bad, to be honest, because, they had put a lot of time in, and even though they were kind of jerking us around a little bit, it was, you don't like to, see people lose a deal, and they put a lot of time and effort into it. So that was a very hard phone call to make, but ultimately just had to, make the best business decision. And then, that was clear what it was.
Ricky and Jake were 2 of your partners in College Humor. Did they join you in TeePublic?
They did not. So Ricky stayed at College Humor for a couple of years, and then went to Facebook. He's been at Facebook for several years. I lost track of how long it's been. And then Jacob, when he left, started working on some, music related tech projects and some art stuff, and was kind of, had an eclectic group of companies that he was spending time on.
Have you kept in touch?
Yeah. I still.
How do they feel about the success of TeePublic?
I think everybody was really excited about it. I think, I think people were surprised that, Busted Tees, which I think I had a couple of moments when I bought back the Busted Tees business where I ran into a guy that I don't really know super well, but, all he said was like, is that going to be like, are you going to be able to like support a family in New York on this t-shirt business? Like those kind of questions. And you're like, okay, like I could feel my sort of place in the world take a big step down. Like College Humor was cool and people liked it. And I would get like meetings with important people who like cared what I had to say about things. And then I kind of went from that to like owning this like little t-shirt business, and you could just feel it. Like people just didn't care about me as much. I didn't get invited to the same entrepreneur events. I didn't get, a lot of the stuff that I had become, I was identified so much as the College Humor guy. When I was stripped of that, that was another example of something that, you can sort of imagine how something's going to make you feel, but until you actually go through it, it's, it's really hard to imagine. And that was very much the case with College Humor and leaving and going to Busted Tees. And I didn't feel great about myself. I sort of felt like I had been a little bit of a failure at IAC in a way because, I sold them a business and it didn't go as well as I'd wanted. And when I was first building the College Humor business, I felt like 10 out of 10, amazing. Like, this is so fun. I'm working with my best friends. I'm like, this thing's working. Like, people think it's cool. Like, it was everything. And then I went from that to feeling like, just getting yelled at by Barry Diller, and like, that didn't feel good. And like, I just didn't feel like I was great at my job because he wasn't happy, and, those types of things. And then it wasn't really until Busted Tees happened and I built TeePublic and that became a success that I sort of regained confidence and felt like, okay, like I did this a second time. Like, it wasn't just a fluke. Like, I know how to do this. Like, I'm not bad at business, like all these sort of self-doubts that you have when something doesn't go exactly as you imagined. So yeah, I think, everybody, certainly my close friends, I think we're all like super excited about it. And
what was your dad's reaction?
He was super excited too. I think, he's been really helpful to me, like I said, since I was 18. And, he actually left his job right around the time when I had started College Humor, and sort of ended up retiring a bit earlier than he had anticipated. So he had a lot of free time to help me, in all of my businesses. In the TeePublic business, I mean, he was essentially acting as our CFO towards the end, never really like hired for that position. But by the end, he was, he had an accounting background and was much more patient with numbers than I am. So it was really helpful. So I think
you gave your old man some options.
Yeah, I did actually. So he was excited, and he was super close to it. So he knew, every step of the way what was happening.
Sure. You've been super generous with your time. Are you up for a very quick lightning round of just a word or two answers on a couple of questions?
Sure.
Sure, he says exhausted.
Yeah.
What was the slimiest trick? I mean, you talked to lots of potential acquirers, investors, private equity groups. Slimiest trick a potential acquirer tried to play on you in the process of selling one of your companies?
I don't know that anybody was super slimy. I think, when we thought we had a deal to sell our business to Viacom before IAC, and I just thought that it was like a done deal, and we were getting sort of wined and dined and flown to, the Video Music Awards in Miami and all these cool things. And, but they didn't do anything wrong. I was just naive to think that the deal was like, definitely happening when it most definitely was not anywhere close to approved. So, I don't think, fortunately, I haven't had to deal with anybody being too slimy. I've had to deal with Barry Diller, like breaking my back, figuratively, but I haven't had to deal with, it was never, slimy isn't the right word. It's more just like aggressive and being, good at business.
Biggest mistake you made in the process of selling TeePublic? I
don't think I made a mistake. I think that deal was sort of like perfectly executed in a way. I think, you know, you could argue I should have held the business, you know, whatever, but I think the price was totally fair. I was able to leave after 2 months, which is what I wanted. Um, you know, it all sort of just fell into place very nicely. So I don't have any regrets on how the deal was done.
I think you already answered this question about the lowest emotional point you reached in the process of selling, which happened, as I understand it, after you sold TeePublic. What was the highest point emotionally for you?
I think, you know, like going through diligence with one of these deals when at the end of, you know, the road, you like, you know, there's just this big pile of money and you're very excited about that. And not just the money, although that's the main piece of it. It's also just this like solidifying, like this was a win, you know, which I think is also, you know, as an entrepreneur, that's how you judge yourself. And I think that was important. So, you know, you get, it's like every morning I would wake up, and they're based in Australia. So, you know, a lot of times I'd wake up in the morning and I'd have 200 questions to answer. And some of them required, you know, reaching out to like 4 other people and like, you know, just a lot of work. But I was so energized because I'm like, I'm going to like get all of this done as quickly as possible. I really felt like, you know, again, the time is the enemy of all deals, like that mantra, just like in my head, like you have to get this done. You have to get this done. So I was really, I was working really hard to get it done, but I was really enjoying that. And then, you know, that up until like, you know, it actually closing and being done, like that was all super exciting. I think, you know, what's the saying, like better to travel hopefully than to arrive. Like there's definitely a bit of that in the deal process where, you know, the final weeks of the deal are more exciting than the, you know, few weeks afterwards when you just like had a, you know, big wire hit your checking account.
You're the first guy I've ever met who liked due diligence, by the way. That's a first for sure. What did you turn to? Go ahead.
No, I was just going to say, I think it's more about just like having like such a clear purpose of what you need to accomplish
Right.
on a given day or in a given week. And it was just like, you know, because usually as an entrepreneur, you're sort of feeling it out as you go. And it's like, I'm going to like, maybe this is the right thing, maybe not. And you're, you know, it's hard to at times know where to put your energy. When this was happening, not to say that the diligence was fun, you know, in and of itself, but just sort of having that focus of like, all right, we know what we need to do. We just need to get this deal done. I don't need to focus on growing the business. I don't need to do anything except like answer these like 1,700 questions and get this deal negotiated and be done. And that, you know, I enjoyed that.
How did you teach yourself about the process of selling a business? Is there a YouTube channel, a TED Talk, a course, a book that you can point our listeners to that's worth checking out?
Not really. I think I remember when I did my first deal, there was a guy who's become a good friend named Mo Koifman who worked at 𝙁𝙊𝙐𝙇𝙇, and he was a young guy, but was like, you know, I think his title was Vice President of Mergers and Acquisitions. And I just remember hearing him talk through all the deal points. And I was like, how, this guy's not that much older than me. Like, how does he know all these words and like what all this stuff means? Like, I was just so like in awe of like, I knew he'd like gone to Wharton and I knew he'd worked at 𝙁𝙊𝙐𝙇 for a while, but I really was like, I don't know that I'll ever like know how to do this. You know, it's just, it seems like such a huge amount of knowledge to acquire. And then by the time I did the second deal, you know, I'd done enough, you know, early stage investing, spending 5 years at 𝙁𝙊𝙐𝙇 and just sort of, you know, the osmosis of being involved with some deals there. And, you know, you pick up little bits and pieces and then all of a sudden, you know, you're not just like looking at, you know, another language when you see, you know, the documents or you know, what the different terms mean. And then I think also having really good lawyers who can explain some of the things that, you know, maybe aren't intuitive or, you know, maybe I understand what they mean, but I don't really know what, like, the market terms should be, or, so I think
Sure.
I learned a lot from just working with great lawyers. Our first deal, I worked with Allen and Company, and learned a lot from those guys. So I think it's a little bit of like, each deal I learned a little bit more. And then that was also one of the satisfying things about the TeePublic deal, was just feeling like, oh, I actually like, I know how to do this. Like, I'm not just like completely relying on other people's judgment. Like, I'm actually making the decisions, and just realizing how far I've come from that first deal where I was really just like, on the calls and kind of glazing over because I didn't know what any of the words actually meant.
Last question. Tell me you bought yourself a trophy when you sold TeePublic.
It was a little bit anticlimactic because I already had an apartment that I was living with my family. I bought a beach house a couple 2 years earlier, maybe. So like, that was kind of like my big thing that I was excited about. So like, nothing really changed. I collect watches. So I bought a nice watch, but nothing.
What'd you buy?
Well, I guess I bought a few, but I bought a couple Patek Philippe's 3940R, and I got old Rolex Daytona 6263 with the Sigma dial for any of the watch collectors out there. But that was, I was starting to get into watch collecting like right around that time. Coincidentally, I've sort of sold a big chunk of my watches just because sometimes I get into these things and then they become less exciting. And then I'm like, why do I have all this money tied up in wristwatches? That's maybe unnecessary.
Well, hang on to one of them, because I'm a huge believer in having something physical to commemorate the accomplishment, to kind of look back on. Not necessarily materialistic, but at least something physical that you can feel and touch. And
well, the issue is,
remember.
I'm a wine collector, and I'm in the wine business now. And wine has sort of taken the place of like, if I have a big event in my life, I drink a nice bottle of wine. But that is extremely ephemeral, and you're not holding on to it indefinitely. It's just sort of, it and I think that's part of what I love about it, is that it's, it sort of amplifies an evening and everybody sort of recognizes that it's special. But I don't like keep the bottle for the closing dinner or anything like that.
Yeah. Where can people find your wine business? What's the URL?
The wine business is called Parcel. So it's parcelwine.com. We have a wine bar here in New York City on the Lower East Side of Manhattan. And then we sell wine on the internet.
Awesome. So we'll put links to that as well in the show notes. And is there a best place if someone wanted to reach out to you on social media? Are you like a Twitter guy or more LinkedIn, or what's the best place for people to reach you? Or are you anonymous these days?
Yeah, I try not to tweet. And I have like 1,000 LinkedIn messages that I realized I had the other day that I never checked. So that's probably not the best place either. But yes, I don't have a great answer. But I guess Facebook sometimes. I don't know.
We'll tell people to buy a bottle of wine from Parcel.
Yeah, exactly. They can. Yeah, when they buy a bottle of Parcel, I'll send them a note to thank them.
Josh, I have to say this because oftentimes I'll interview an entrepreneur who's onto a new business, and like they're doing it because they want the publicity for their new business. And in your case, I just get a sense of genuine wanting to give back to the entrepreneurial community, genuinely sharing your story with as much candor as you could muster. And I really appreciate that, because you've obviously had an incredibly successful entrepreneurial career so far, lots more to come, but you've really come at this from the standpoint of just giving without expecting anything in return. So I just want to say thank you on behalf of all of our listeners for your generous time today.
Yeah, of course. Thanks for having me.
We will put everything Josh related in the show notes at builttosell.com. Josh, thanks for doing this.
Awesome. Thank you.